Small cap dividends. Can SYLD ETF deliver big gains and income? Hey investing friends! Are you looking for an ETF that delivers both income and growth potential? Look no further than SYLD, the Shareholder Yield ETF focused on small-cap companies with a history of returning cash to shareholders through dividends, buybacks, and debt paydown. But before you jump in, let's dig deep and answer the crucial question: can SYLD really live up to its promises? In this video, we'll dive into the nitty-gritty of SYLD, exploring its investment strategy, strengths and weaknesses, and potential risks. We'll compare it to other income-generating options and help you decide if it's the right fit for your portfolio. So, grab your financial binoculars, buckle up, and let's explore the world of small-cap dividends. Question 1. What distinguishes SYLD ETF strategy from other small-cap-focused ETFs? The Cambria Shareholder Yield ETF, SYLD, carves a unique path in the small-cap world, distinct from its peers in both its selection criteria and its targeted outcomes. While traditional small-cap ETFs prioritize market value and growth potential, SYLD flips the script, focusing on a novel approach, prioritizing cash returns to shareholders. SYLD doesn't simply throw darts at the small-cap board. Instead, it meticulously selects companies based on their demonstrably high shareholder yield, a metric that encompasses three key components: dividends, regular cash payouts that directly land in investors' pockets; share buybacks, strategic repurchases of company shares, which can boost the stock price by reducing the total number of shares outstanding; debt paydown, reducing debt not only improves the company's financial health, but also frees up additional cash that can be used for shareholder benefit, such as higher dividends or more buybacks. Traditional small-cap ETFs, in contrast, tend to prioritize companies based on their market capitalization, typically under $2 billion, and their potential for future growth. This often leads them to invest in young, high-growth companies that may not prioritize returning cash to shareholders in the near term. They may reinvest their profits back into the business to fuel expansion, leaving investors waiting for potential capital appreciation down the line. SYLD's shareholder yield focus resonates with two distinct investor groups. Income seekers. For those who prioritize regular cash flow, SYLD's emphasis on dividends and buybacks offers a compelling proposition. The ETF acts like a dividend machine, churning out cash distributions that can be reinvested or used to supplement income. Value investors. Value investors typically seek companies with strong fundamentals and efficient capital allocation. SYLD's focus on companies that return cash to shareholders arguably aligns well with these principles, as it indicates sound financial management and a commitment to rewarding investors. For investors seeking a small-cap ETF that prioritizes income generation and value characteristics, SYLD stands out as a compelling option. Its shareholder yield strategy offers a unique approach that caters to specific investment goals. Question 2. Which criteria are pivotal in selecting stocks for SYLD's portfolio? SYLD's unique strategy hinges on selecting stocks based on their shareholder yield. This metric is a blend of three key components, each playing a crucial role in stock selection. 1. Dividends. SYLD prioritizes companies with established and consistent dividend payouts. This ensures a steady stream of cash flow for investors. The dividend yield, which measures the annual dividend payment as a percentage of the stock price, is also considered. Higher yields are generally preferred, but they must be sustainable and supported by strong fundamentals. 2. Share buybacks. SYLD favors companies with a history of actively repurchasing their own shares. This reduces the number of outstanding shares, which can boost the stock price and increase earnings per share, EPS. The amount and frequency of buybacks are analyzed. Companies with consistent and sizable buyback programs are more likely to be included in the portfolio. 3. Debt paydown. SYLD prefers companies with low or manageable debt levels. This indicates financial stability and reduces the risk of future financial distress. The rate of debt reduction is also considered. Companies that are actively paying down debt are viewed favorably, as this frees up cash that can be used for other shareholder-friendly activities like dividends or buybacks. Beyond the core. While these three pillars form the foundation of SYLD's selection criteria, other factors are also considered. 1. Industry diversification. The portfolio aims to be spread across various sectors to mitigate risk. 2. Company size. SYLD primarily focuses on small-cap companies, market capitalization between $200 million and $2 billion, but some larger companies may also be included if they meet the shareholder yield criteria. 3. Financial health. Companies with strong balance sheets, healthy cash flow, and consistent profitability are preferred. 4. Valuation. SYLD seeks undervalued companies with the potential for future price appreciation in addition to their shareholder yield. By understanding these key criteria, you gain valuable insight into the philosophy behind SYLD's stock selection process and how it differs from traditional small-cap ETFs. Question 3. How does SYLD ETF manage risk within its investment strategy? SYLD ETF incorporates several strategies to manage risk within its shareholder yield investment strategy. 1. Diversification. Across sectors, the portfolio is spread across various sectors to avoid overexposure to any single industry, mitigating the impact of sector-specific downturns. Within sectors, the ETF holds multiple companies within each sector, further reducing concentration risk. By company size, while primarily focused on small-cap companies, some larger companies with strong shareholder yield profiles may be included, offering some exposure to less volatile stocks. 2. Focus on quality. Financial health. SYLD prioritizes companies with strong balance sheets, healthy cash flow, and consistent profitability. This reduces the risk of defaults or financial distress. Debt management. Low or manageable debt levels are preferred, minimizing risk associated with excessive leverage and interest rate fluctuations. 3. Active management. Dynamic adjustments. The portfolio is actively managed, allowing the manager to adjust holdings based on market conditions and individual companies' performance. This flexibility helps navigate market volatility and identify new opportunities. Risk monitoring. The manager continuously monitors portfolio risk metrics and adjusts allocations as needed to maintain risk within acceptable parameters. 4. Investment thesis. Focus on shareholder-friendly companies. By prioritizing companies that prioritize returning cash to shareholders, SYLD aims to invest in companies with strong fundamentals and a commitment to rewarding investors. This can potentially lead to lower volatility compared to growth-oriented companies that may reinvest profits back into the business. By understanding these risk management strategies, you can make informed decisions about whether SYLD aligns with your individual risk tolerance and investment goals. Consulting with a financial advisor is always recommended before making any investment decisions. Question 4. What is SYLD ETF's portfolio turnover rate, and how does it impact tax efficiency? SYLD's portfolio turnover rate is 41%, which means the average holding period for a stock in the portfolio is roughly 2.4 years, 1/0.41. This is considered relatively high turnover compared to the median of 25% for equity ETFs, and even higher than the median of 39% for all funds. Higher turnover generally leads to lower tax efficiency. When the ETF buys and sells securities frequently, it triggers capital gains, which are then distributed to investors. These capital gains can be taxed at short-term rates if held less than a year, or at the potentially lower long-term capital gains rate if held for more than a year. With SYLD's high turnover rate, there is a higher probability of receiving short-term capital gains distributions, potentially leading to higher tax liability for investors. This is particularly relevant for taxable accounts, where capital gains are realized and taxed upon distribution. SYLD's high portfolio turnover rate can be a significant factor to consider, especially for investors in taxable accounts. While it may offer benefits in terms of income generation and value characteristics, the potential tax implications should be carefully weighed against your investment goals and risk tolerance. Question 5. Can you explain SYLD ETF sector allocation strategy and its role in diversification? SYLD's sector allocation strategy differs from traditional small-cap ETFs in a key way. It prioritizes sectors with companies known for returning cash to shareholders through dividends, share buybacks, and debt paydown, aligning with its shareholder yield philosophy. While the specific sector weights can fluctuate, some general trends emerge. Overweight sectors. Financials often contain companies with strong dividend traditions, like banks and insurance companies. Consumer discretionary may include companies with large buyback programs, particularly in sectors like retail and apparel. Industrials can house companies with steady cash flow and a history of returning capital to shareholders through dividends or buybacks. Underweight sectors. Technology. While some tech companies pay dividends, the sector is generally known for reinvesting heavily for future growth, resulting in lower shareholder yield profiles. Communication services. Similar to tech, this sector often prioritizes reinvestment over dividends and buybacks. Energy. While some energy companies offer substantial dividends, SYLD may underweight this sector due to its cyclical nature and potential for higher volatility. Role of diversification. Sector diversification is crucial for managing risk. By not concentrating in any single sector, SYLD aims to mitigate the impact of sector-specific downturns. However, SYLD's sector allocation is not purely about minimizing risk. It's designed to align with the shareholder yield strategy, seeking sectors with companies historically known for returning cash to shareholders. This targeted diversification can offer a different risk-reward profile compared to traditional small-cap ETFs, potentially offering higher income generation at the expense of some higher volatility. By understanding SYLD's sector allocation strategy and its role in diversification, you can gain valuable insight into the ETF's approach to risk management and how it seeks to achieve its investment objectives. Question 6. How does SYLD ETF's expense ratio compare to similar small-cap ETFs, and is it justified by performance? SYLD ETF has an expense ratio of 0.6%, which places it on the higher end compared to other small-cap ETFs. The median expense ratio for U.S. small-cap value ETFs is around 0.35%, and some low-cost options exist with expense ratios below 0.1%. While SYLD's returns appear decent, they are significantly lower than the Russell 2000, IWM, the benchmark for U.S. small-cap stocks, after accounting for the higher expense ratio. Compared to VIOO, a small-cap value ETF with a similar strategy and lower expense ratio, SYLD's performance is marginally better, but the difference might not justify the higher cost for all investors. It's difficult to definitively say whether SYLD's expense ratio is justified solely by its performance. Ultimately, it depends on your investment goals and risk tolerance. If you prioritize high income generation and are comfortable with potentially lower returns and higher volatility, SYLD's shareholder yield strategy might be appealing despite the higher expense ratio. If you prioritize maximizing returns and are comfortable with lower income and potentially higher volatility, lower-cost small-cap ETFs might be a better choice. Question 7. What are the primary factors driving the current outlook for small-cap stocks, and how does SYLD ETF position itself in response? Predicting the future, especially in the ever-evolving world of finance, is a tricky proposition. However, we can analyze some key factors influencing the current outlook for small-cap stocks and how SYLD ETF positions itself in response. Macroeconomic landscape. Interest rates. Rising interest rates, a potential scenario in 2024, can dampen investor enthusiasm for riskier assets like small caps. SYLD's focus on companies with consistent dividends and buybacks might offer some shelter, as these actions can be seen as a return of capital, potentially mitigating the impact of higher rates. Inflation. Persistent inflation can squeeze corporate profits and consumer spending, impacting small-cap companies more acutely. SYLD's emphasis on companies with strong fundamentals and efficient capital allocation might help them weather inflationary pressures better. Economic growth. A potential slowdown in economic growth can disproportionately impact small caps. SYLD's focus on undervalued companies with potential for growth could offer some upside, but investors should be prepared for potential volatility. Valuation and sentiment. Small cap valuations. Compared to their large cap counterparts, small caps might be trading at more attractive valuations, potentially indicating some discount. SYLD's focus on undervalued companies aligns well with this scenario. Investor sentiment. Small-cap stocks can be more susceptible to investor sentiment swings. If risk aversion prevails, SYLD's income-generating characteristics might become more appealing to income-seeking investors. SYLD's strategic response. Maintaining shareholder yield focus, SYLD will likely continue to prioritize companies with strong cash returns through dividends, buybacks, and debt paydown, regardless of the broader market environment. Active management. The ETF's actively managed nature allows for adjustments to holdings based on market conditions. The manager can potentially add or remove companies based on their shareholder yield potential and their ability to navigate the current climate. Income generation. In uncertain times, income-generating assets can become more attractive. SYLD's focus on dividends and buybacks might appeal to investors seeking regular cash flow. Question 8. How does SYLD ETF identify and capitalize on emerging trends within the small-cap market? Identifying and capitalizing on emerging trends within the small-cap market requires a dynamic and multifaceted approach. Here's how SYLD ETF tackles this challenge. 1. Active management. Unlike passively managed ETFs that simply track an index, SYLD benefits from active management, allowing the portfolio manager to make investment decisions based on their research and insights. The manager actively researches and analyzes small-cap companies, identifying those exhibiting characteristics aligned with the shareholder yield strategy and emerging trends within specific industries or sectors. 2. Data-driven analysis. The manager utilizes quantitative and qualitative data analysis to identify trends. This includes financial data, industry reports, news articles, and even social media sentiment analysis. By analyzing this data, the manager can spot early signs of growth in specific industries or business models that align with SYLD's objectives. 3. Focus on innovation and disruption. SYLD doesn't shy away from companies at the forefront of innovation and disruption. While these companies may carry higher risk, they also have the potential for significant growth if their innovations gain traction. The manager actively seeks out companies that are well-positioned to benefit from emerging trends, such as the rise of e-commerce, artificial intelligence, or renewable energy. 4. Flexibility and adaptability. The active management style allows for flexibility and adaptability. The manager can quickly adjust the portfolio based on new information and changing market conditions. This is crucial for capturing emerging trends, as they often evolve rapidly and require swift action to capitalize on them. 5. Collaboration and expertise. The investment team behind SYLD leverages the expertise of research analysts and industry specialists who provide valuable insights into emerging trends and potential investment opportunities. This collaborative approach helps ensure that the ETF stays ahead of the curve and identifies promising trends before they become mainstream. Question 9. How does SYLD ETF incorporate fundamental analysis into its stock selection process? SYLD ETF's shareholder yield strategy hinges on selecting companies with strong fundamentals that prioritize returning cash to shareholders. Here's how fundamental analysis plays a crucial role in its stock selection process. 1. Financial strength. Profitability. SYLD seeks companies with consistent profitability, measured by metrics like earnings per share, EPS, and operating margins. This ensures they have the financial resources to sustain dividends, buybacks, and debt payments. Balance sheet analysis. A healthy debt-to-equity ratio and ample cash reserves are crucial factors. Low debt levels mitigate financial risk, while cash reserves provide flexibility for future shareholder-friendly actions. Cash flow analysis. Strong and consistent cash flow generation is vital. This indicates the company can comfortably afford its dividend payouts and potentially increase them in the future. 2. Growth potential. While not the primary focus, SYLD considers a company's growth potential alongside its shareholder yield profile. Metrics like revenue growth, market share expansion, and new product pipelines are analyzed. Identifying companies with both strong fundamentals and the potential for future growth can enhance the overall return potential of the ETF. 3. Valuation. SYLD seeks undervalued companies with the potential for price appreciation. This involves comparing the company's stock price to various valuation metrics like price-to-earnings, PE, ratio, and price-to-book, PB, ratio. By investing in undervalued companies with strong fundamentals and a commitment to shareholder returns, SYLD aims to offer investors a compelling risk-reward proposition. 4. Qualitative factors. Beyond quantitative metrics, SYLD also considers qualitative factors like management team. A strong and experienced management team with a proven track record of success is crucial for executing the company's strategy and delivering value to shareholders. Corporate governance. Sound corporate governance practices ensure transparency, accountability, and responsible allocation of resources, benefiting shareholders in the long run. Competitive landscape. Understanding the competitive environment the company operates in helps assess its long-term viability and growth potential. 5. Integration with shareholder yield. The fundamental analysis findings are then integrated with the shareholder yield criteria. Companies that demonstrate financial strength, growth potential, and attractive valuation while also prioritizing dividends, buybacks, and debt paydown are prioritized for inclusion in the ETF. Question 10. How does SYLD ETF mitigate the impact of market volatility on its portfolio? SYLD ETF employs several strategies to mitigate the impact of market volatility on its portfolio, but it's important to understand that no strategy can eliminate volatility entirely. 1. Income generation. The core focus on companies with consistent dividends, buybacks, and debt paydown offers a stream of income that can help offset capital losses during market downturns. This income can also be reinvested to potentially compound returns over time. 2. Diversification. Across sectors, the portfolio is spread across various sectors to avoid overexposure to any single industry, reducing the impact of sector-specific downturns. Within sectors, the ETF holds multiple companies within each sector, further reducing concentration risk. By company size, while primarily focused on small-cap companies, some larger companies with strong shareholder yield profiles may be included, offering some exposure to less volatile stocks. 3. Focus on quality. Financial health. SYLD prioritizes companies with strong balance sheets, healthy cash flow, and consistent profitability. This reduces the risk of defaults or financial distress during market downturns. Debt management. Low or manageable debt levels minimize the risk associated with excessive leverage and interest rate fluctuations, making them more resilient to market shocks. 4. Active management. Dynamic adjustments. The portfolio is actively managed, allowing the manager to adjust holdings based on market conditions and individual companies' performance. This flexibility enables taking advantage of calmer periods and potentially reducing exposure to riskier assets during volatile times. Risk monitoring. The manager continuously monitors portfolio risk metrics and adjusts allocations as needed to maintain risk within acceptable parameters. 5. Investment thesis. By focusing on companies that prioritize returning cash to shareholders, SYLD aims to invest in companies with strong fundamentals and a commitment to rewarding investors. This can potentially lead to lower volatility compared to growth-oriented companies that may reinvest profits back into the business, exposing them more to market swings. Question 11. What are the criteria for adding or removing stocks from SYLD ETF's portfolio? The selection and removal of stocks within SYLD's portfolio is a meticulous process guided by several key criteria. Adding stocks. Alignment with shareholder yield strategy. This remains the core principle. Companies must demonstrate a strong commitment to returning cash to shareholders through consistent dividends, a history of reliable and potentially growing dividend payouts. Active share buybacks, a track record of repurchasing shares to boost shareholder value. Meaningful debt paydown. Reducing debt frees up cash for future shareholder-friendly actions. Financial strength. Companies with strong balance sheets, healthy cash flow, and consistent profitability are preferred to minimize risk and ensure sustainability of shareholder returns. Growth potential. While not the primary focus, SYLD considers companies with the potential for future earnings and revenue growth, enhancing the overall return potential. Valuation. Undervalued companies with the potential for price appreciation are prioritized, offering an attractive entry point and potentially amplifying returns. Qualitative factors. Management team expertise, corporate governance practices, and competitive landscape are also considered to assess long-term viability and risk. Removing stocks. Deterioration in shareholder yield profile. If a company significantly reduces or eliminates dividends, ceases buybacks, or increases debt excessively, it might be removed. Financial deterioration. Declining profitability, weakening balance sheet, or negative cash flow could trigger removal to mitigate risk. Valuation concerns. If a stock becomes significantly overvalued, it might be sold to capture gains and reinvest in more attractive opportunities. Changes in industry or company fundamentals. If the company's industry or business model faces significant headwinds, or its long-term prospects diminish, removal might be considered. Question 12. How does SYLD ETF's investment strategy adapt to changes in market conditions and economic outlook? SYLD ETF's investment strategy incorporates several features that enable it to adapt to changing market conditions and economic outlook. 1. Active management. Unlike passively managed ETFs, SYLD benefits from active management, allowing the portfolio manager to adjust holdings based on market developments and their assessment of individual companies. This flexibility is crucial for navigating changing economic landscapes. 2. Focus on fundamentals. While shareholder yield is central, SYLD prioritizes companies with strong financial health, consistent profitability, and manageable debt. These factors become even more important during economic downturns, as they indicate resilience and the ability to sustain shareholder returns. 3. Sector diversification. The portfolio is spread across various sectors, mitigating the impact of sector-specific downturns. The manager can also dynamically adjust sector weightings based on their outlook for different industries in changing economic conditions. 4. Company selection flexibility. The selection criteria allow for considering companies of different sizes and growth profiles. During uncertain times, the manager might favor larger, more established companies with proven track records, while in favorable economic periods, they might incorporate more high-growth potential companies with attractive shareholder yield profiles. 5. Valuation awareness. The focus on undervalued companies becomes even more critical as economic uncertainties rise. The manager can seek out companies with temporarily depressed valuations due to broader market sentiment, offering potential for future appreciation when the outlook improves. 6. Continuous monitoring and analysis. The portfolio is constantly monitored, and the manager regularly assesses companies' performance and financial health in light of changing economic conditions. This allows for prompt adjustments to maintain alignment with the investment objectives and risk tolerance. Question 13. How does SYLD ETF strategy address potential liquidity constraints within the small-cap market? Liquidity constraints, characterized by difficulty buying or selling securities quickly and at fair prices, pose a potential challenge for any small-cap ETF, including SYLD. However, SYLD's strategy incorporates several features to mitigate these limitations. 1. Focus on larger small caps. SYLD primarily invests in small-cap companies with larger market capitalizations, typically within the $200 million to $2 billion range. These companies generally have higher trading volumes and greater analyst coverage, improving their liquidity compared to microcap stocks. 2. Active management. The active management style allows the portfolio manager to strategically select companies with higher liquidity. They can analyze factors like average daily trading volume and bid-ask spreads to prioritize companies with easier entry and exit points. 3. Diversification across sectors. Spreading the portfolio across various sectors helps reduce reliance on any single security or industry, mitigating the impact of potential liquidity issues within specific pockets of the market. 4. Investment horizon. SYLD is designed for a longer-term investment horizon, encouraging investors to hold shares for periods longer than just a few days or weeks. This reduces the pressure for immediate liquidity and allows the manager to focus on companies with strong fundamentals and long-term growth potential, even if their daily trading volume might be lower. 5. Authorized participants, APs. SYLD utilizes authorized participants, APs, large institutions that create and redeem ETF shares. These APs have the responsibility to ensure sufficient liquidity by providing in-kind creations or redemptions of the underlying securities, helping maintain a smooth flow for larger investors. 6. Market making. The ETF provider might engage market makers to facilitate trading of the ETF shares, further enhancing liquidity and ensuring investors can buy or sell their shares efficiently. Despite these measures, liquidity constraints remain a potential risk for SYLD investors, especially during periods of market turmoil or for individual holdings with lower trading volumes. Question 14. How does SYLD ETF strategy provide a differentiated exposure to small-cap stocks compared to actively managed funds in the same space? While other actively managed small-cap funds also seek to outperform the market, SYLD offers distinct characteristics that set it apart. Differentiation through shareholder yield. Focus on cash return. Unlike many actively managed small-cap funds that prioritize capital appreciation, SYLD prioritizes companies with a history of returning cash to shareholders through dividends, buybacks, and debt paydown. This strategy aims to generate consistent income regardless of market conditions. Targeted selection. SYLD's criteria for selecting companies with strong shareholder yield profiles differ from traditional growth-oriented approaches, potentially leading to a different portfolio composition and risk-reward profile. Active management with a twist. Quantitative and qualitative analysis. SYLD's active management incorporates both quantitative data analysis and qualitative factors like management expertise and corporate governance, providing a more comprehensive assessment of companies. Flexibility in company selection. The focus on shareholder yield allows for flexibility in company selection, potentially including established companies with consistent dividends alongside high-growth companies with active buyback programs. Additional differentiators. Lower expense ratio. Compared to some actively managed small-cap funds, SYLD boasts a relatively lower expense ratio, potentially enhancing returns for investors. Tax implications. The focus on consistent dividends and buybacks can lead to higher portfolio turnover and potentially more short-term capital gains distributions, impacting tax liability for taxable accounts. Question 15. How does SYLD ETF sector allocation align with overall investment strategy and risk tolerance? SYLD ETF sector allocation plays a crucial role in aligning with its overall investment strategy and catering to specific risk tolerances. Alignment with shareholder yield strategy. Overweight financials. This sector often houses companies with strong dividend traditions, like banks and insurance companies, directly contributing to SYLD's income generation focus. Consumer discretionary. Companies with large buyback programs, particularly in retail and apparel, can be prevalent in this sector, further aligning with the shareholder yield focus. Industrials may include companies with steady cash flow and a history of returning capital to shareholders through dividends or buybacks. Balancing income and risk. Underweight technology and communication services. These sectors are known for reinvesting heavily in growth, potentially offering lower shareholder yield but also higher potential returns. This underweight allocation might appeal to investors seeking a balance between income generation and potential capital appreciation while managing volatility associated with these sectors. Focus on established sectors. The overweight sectors generally have a longer track record and are considered less cyclical compared to sectors like technology or energy. This can be suitable for investors with moderate risk tolerance seeking income with potentially lower volatility. Flexibility and adaptability. Active management. The portfolio allocation is not static. The manager can adjust sector weightings based on market conditions, individual company performance, and their assessment of each sector's shareholder yield potential. This allows for dynamic adjustments to cater to changing risk tolerances or market outlooks. Question 16. What are the potential risks associated with investing in high-dividend stocks, and how does SYLD ETF manage them? Investing in high-dividend stocks, like those prioritized by SYLD ETF, comes with several potential risks. Here's a breakdown of the key risks and how SYLD manages them. 1. Unsustainable dividends. Risk. Companies might cut or suspend dividends due to financial difficulties, impacting income generation and potentially leading to stock price declines. SYLD's management focuses on companies with strong financial health, consistent profitability, and manageable debt, aiming to minimize the risk of unsustainable dividends. 2. Lower growth potential. Risk. High-dividend companies may prioritize returning cash to shareholders over reinvesting in growth, potentially limiting future stock price appreciation. SYLD's management considers growth potential alongside shareholder yield profile, potentially including some high-growth companies with active buyback programs, aiming for a balance between income and growth. 3. Higher volatility. Risk. High-dividend stocks, especially in cyclical sectors, can be more volatile than the broader market, impacting portfolio stability. SYLD's management employs diversification across sectors, focuses on larger small-cap companies with higher liquidity, and actively manages the portfolio to mitigate volatility. 4. Tax implications. Risk. Dividends and buybacks can generate short-term capital gains, potentially leading to higher tax liabilities for taxable accounts. SYLD's management cannot control tax implications, but investors should be aware of potential tax consequences before investing. Additional considerations. Dependence on market conditions. The effectiveness of risk management strategies can vary depending on market conditions and economic cycles. No guarantee of success. Even with risk management measures, there is no guarantee that SYLD will outperform the market or avoid losses. Question 17. How sensitive is SYLD ETF to changes in interest rates? SYLD ETF sensitivity to changes in interest rates is a complex issue with several factors at play. Potential negative impacts. Higher interest rates can make fixed-income alternatives like bonds more attractive, potentially leading investors to sell dividend-paying stocks like those in SYLD, impacting its price. Higher borrowing costs for companies can put pressure on corporate profits and potentially lead to dividend cuts, reducing SYLD's income generation. Valuation impact for certain sectors. Sectors heavily reliant on debt, like real estate, might be disproportionately impacted by higher rates, potentially affecting SYLD's performance if it has significant exposure to these sectors. Potential mitigating factors. Focus on companies with strong fundamentals. SYLD prioritizes companies with healthy balance sheets, strong cash flow, and manageable debt, making them less susceptible to the negative impacts of higher rates. Income generation. Even if stock prices decline, SYLD's focus on dividends and buybacks can still provide investors with regular income, potentially offering a hedge against inflation. Sector diversification. Diversification across sectors can help mitigate the impact of higher rates on specific industries. Active management. The manager can adjust sector weightings and holdings based on their assessment of interest rate sensitivity, potentially reducing exposure to vulnerable sectors. Overall sensitivity. While SYLD is not immune to changes in interest rates, its focus on companies with strong fundamentals, income generation, and diversification can help mitigate some of the negative impacts. However, the exact sensitivity will depend on the magnitude and speed of interest rate changes, as well as the broader market environment. Question 18. What is the impact of inflation on the purchasing power of SYLD ETFs dividends? Inflation can certainly impact the purchasing power of SYLD ETFs dividends, but the effect depends on several factors. Negative impacts. Erosion of purchasing power. If inflation rises faster than the growth in SYLD's dividends, the real value of those dividends, what you can buy with them, will decrease. This can be especially concerning for investors relying on the income stream for living expenses. Potential dividend cuts. In extreme cases, persistent high inflation could pressure companies to cut or suspend dividends to preserve cash flow, further reducing purchasing power. Potential mitigating factors. Historically, dividend growth has outpaced inflation. While not guaranteed, past data shows that dividend growth for companies like those in SYLD has often outpaced inflation over the long term. This helps maintain the purchasing power of dividends. Focus on sectors with inflation-resistant dividends. SYLD has some exposure to sectors known for raising dividends regularly, like financials and consumer staples, which can help offset inflation's impact. Potential for capital appreciation. If inflation leads to higher corporate profits and stock prices, SYLD's capital appreciation could potentially compensate for some loss in purchasing power from dividends. Overall impact. The impact of inflation on SYLD's dividends depends on various factors, making it difficult to predict with certainty. While inflation can erode purchasing power, SYLD's historical track record, sector focus, and potential for capital appreciation can offer some mitigation. Question 19. What are the potential regulatory risks associated with high-dividend ETFs, and how does SYLD ETF address them? While high-dividend ETFs offer attractive income potential, they also come with potential regulatory risks. Here's a breakdown of the key concerns and how SYLD ETF addresses them. Potential regulatory risks. Changes to tax treatment of dividends. Governments might alter tax policies on dividends, making them less favorable for investors, impacting the appeal of high-dividend ETFs like SYLD. Regulation of buybacks. Regulatory scrutiny of corporate share buybacks, a key component of SYLD's strategy, could limit their effectiveness or even lead to restrictions, impacting the ETF's income generation and potentially its performance. Sector-specific regulations. Regulations targeting specific sectors SYLD invests in, like financials or energy, could impact the performance of those sectors and consequently the ETF. How SYLD addresses these risks. Limited control. SYLD, like other ETFs, has limited control over regulatory changes. However, its diversified sector allocation mitigates dependence on any single sector potentially affected by regulations. Transparency and compliance. SYLD adheres to all regulatory requirements and maintains transparency in its holdings and investment strategy. This helps mitigate potential regulatory scrutiny. Focus on fundamentals. By prioritizing companies with strong fundamentals and financial health, SYLD aims to remain resilient even if regulations aimed at curbing excessive payouts or buybacks are implemented. Active management. The ETF's active management allows the manager to adjust holdings based on changing regulations and market conditions, potentially reducing exposure to sectors or companies most vulnerable to regulatory risks. Question 20. What are the alternative investment options available to achieve similar income objectives, and how does SYLD ETF compare to them? Alternative income generating options to SYLD ETF. Several options exist for investors seeking income, each with its own advantages and drawbacks. Traditional fixed income bonds offer predictable income streams, but may be less attractive in rising interest rate environments. Preferred stocks prioritize dividends over common stock, but offer less growth potential and higher volatility. Closed-end funds, CEFs actively managed income-focused funds, but fees can be higher and liquidity lower than ETFs. Real estate investment trusts, REITs, provide income through rental payments, but exposure to the real estate market and potential interest rate sensitivity. Dividend-paying stocks offer income through dividends, but require individual stock selection and potentially higher volatility. Dividend-focused ETFs, similar to SYLD, but diversification and management fees vary across different options. Covered calls generate income by selling call options on stocks you own, but limit potential capital appreciation. Master Limited Partnerships (MLPs) offer high yields, but come with complex tax implications and potential volatility. Comparison to SYLD ETF. Advantages of SYLD. Diversification reduces risk compared to individual stock selection. Professional management actively managed to navigate market changes. Liquidity easier to buy and sell compared to some alternatives. Lower fees compared to actively managed CEFs. Disadvantages of SYLD. Higher volatility compared to traditional fixed income options. Sector concentration, exposure to small-cap stocks and specific sectors. Potential tax implications, higher dividend distributions might lead to higher tax bills. Choosing the right option depends on your risk tolerance. SYLD might be less suitable for conservative investors seeking low volatility. Investment timeframe, long-term investors can better weather SYLD's potential volatility. Tax situation, consider potential tax implications of dividends and fees. Income needs, SYLD offers a consistent income stream, but its amount might vary. So, what's the verdict? Is SYLD worth your investment dollars? Ultimately, the decision depends on your individual goals and risk tolerance. However, we hope this video has provided you with the insights you need to make an informed decision. Remember, diversification is key, and SYLD shouldn't be your only income source. But if you're looking for a potentially dynamic way to generate income and potentially experience some growth in the small-cap arena, SYLD could be a compelling option for you. Don't forget to leave a comment below and let us know your thoughts on SYLD. And if you enjoyed this video, hit the like button and subscribe for more in-depth investment explorations. Happy investing!